John Meriwether, the famous founder for long-term capital management, famously stated that after becoming a billionaire, after 6 years of doing this, don't congratulate me yet, I'm just getting started. So in my mind, was this overconfidence or underconfidence? So today I'm going to tell you a story about long-term capital management. So the story is split into the rise of LTCM, the illusion of control, the collapse, and the key learnings that we can get from this story. The rise of LTCM. In the 1990s, long-term capital management was at its peak of financial success in the whole world. It was founded by John Meriwether, who was a bond trader at Salomon Brothers. So what was impressive about LTCM was that it boasted two Nobel Prize winners, which were Robert Merton and Myron Scholes. So advanced mathematical models were used to identify arbitrage opportunities, and this yielded them over 40% annually. At the height of its peak, LTCM was managing 126 billion US dollars. This was a huge, staggering amount for a hedge fund, and investors were lining up just to get into the door. As LTCM expanded, it relied heavily on its advanced mathematical models. At that point, the firm believed that it had a tight grip on its risk modeling and risk management. So they thought that they discovered the holy grail of financial investing, just like minting gold or the Midas touch. They were confidently engaging in highly leveraged trades, sometimes up to the ratio of 1 to 100, because they believed they eliminated risk entirely. But in the real world of finance, the unexpected is always lurking. And when the tail risk started wagging its tail, and in August 1998, Russian financial markets collapsed. The Russian financial crisis struck and sent shockwaves throughout the world. So LTCM's model, which worked well in stable times, started unraveling in chaotic times. The firm's derivative positions started unraveling and chaos ensued, leading to catastrophic losses. And comes the next chapter, the collapse. Within just a few months, LTCM's positions plummeted. It lost 4.6 billion in just a matter of weeks. The firm was left holding assets which are worth far less than what was purchased. So it had $1.25 trillion in exposure, and this led regulators to be worried about the financial stability of the markets. So to prevent a meltdown, the Federal Reserve planned and orchestrated a rescue plan with many banks involved. Regulators intervened because they realized that financial markets are intertwined, and the large derivative exposure demonstrated how deeply connected the financial system was globally. First, the perils of overconfidence. LTCM heavily relied on its mathematical models, which was performing in stable times, but this failed to protect them from downside risks during times of chaos and crisis. So while mathematical models can provide valuable insight, it cannot predict every single outcome. Second is the understanding of risk. Although they were the experts, over-leverage tend to make things unstable. What seemed like a safe bet during stable times can cause disastrous losses during times of financial crisis. The story of long-term capital management is not just about brilliance, but also a cautionary reminder about managing risk, managing downside, and not over-leveraging. It also showed that in finance and in life, the unexpected can suddenly cause catastrophic losses. Even the greatest geniuses stumble when they think they can eliminate risk entirely. Please comment below if you have any questions and please like the video.